Danie, both of us often discuss smooth bonus products with clients, and as a result, we've had a lot of theoretical conversations with clients about how our smooth bonus products react to periods of volatility. I do think this is a good time for you and I to discuss what actually played out in the various times when markets have moved sharply in either direction. But before we get ahead of ourselves, please will you explain what a smooth bonus portfolio is?
Thank you, Lorraine. Smooth bonus portfolios are portfolios where insurer smooths out volatile investment returns for members. Many members are risk averse, especially those closer to retirement. These members have worked hard for many years to build up their fund value and do not want to risk seeing their savings reduce due to market downturns. In smooth bonus portfolios, investment returns are smooth by way of regular bonus declarations. This results in a more stable and predictable return profile for members, lessening the rollercoaster ride they may otherwise have experienced during a market downturn. Some returns are set aside during periods of strong market growth to be used to boost returns during periods of weaker performance. Through the smoothing process, the portfolios sometimes have a surplus, in other words, returns have been held back, or in times of poor returns, the portfolio may even be in a deficit. We also have a range of portfolios with different guarantee levels and portfolio managers.
Speaking of volatile investment returns, 2020 Q1 is notable and is the most recent, so that's a good place to start. How did smooth bonus products navigate that period?
Yes, Lorraine. The first quarter of 2020 was quite a shock to many retirement fund members, especially those planning to retire at the end of March 2020. On our side, our portfolios did end March 2020 in a deficit. For every 100 Rand that clients saw on their fund statement, we had less than 90 Rand worth of assets to back this. However, the important thing is that members never experienced any negative returns during this period. The worst that members received was a zero bonus, net of fees, in April 2020. Our management process, which includes how we manage these portfolios and how we declare bonuses, was resilient enough to ensure that we could start declaring positive bonuses from May 2020 onwards. What is especially pleasing is that we did not have to tinker with our asset allocation or bonus methodology during this period. Additionally, as our funding level improved quite quickly, we did not have to open new bonus series like some other insurers.
2020 was large and dwarfing of everything else, but I also want us to touch on the other periods of volatility in the South African market that we have navigated. Like 2008, 2009 would have been rough, I would expect.
Yes, the credit crisis of 2008 to 2009 was quite rough. Seeing big financial institutions in both the US and UK close down made everyone worry about our local institutions. We were a bit conservatively positioned going into 2008 and making good use of some derivative protection. This, mind you, wasn't initially popular when we started using derivatives in 2007, as we had just seen 2 years of quite high returns leading up to this, and many members just expected the good times to continue. But our experience during the credit crisis had a lot of similarities with last year. Neither time we were forced to make big changes to our asset allocation and could ride out the market volatility. Our portfolio's fund level position did not deteriorate to the extent that we had to close the portfolios. Most importantly, no member received a negative return.
In South Africa, we've also had our fair share of political issues affecting the market in the last decade. Is there anything that stands out for you?
I joined Sanlam in '98, straight out of varsity. Since then, I've seen the emerging market crisis of 1998, the dot-com bubble bursting, and the impact of state capture. But what stands out for me, and this is something I always try to bring home to retirement fund members, is that I have seen 4 big market downturns since I started saving for retirement. And I'm still more than a decade away from retiring. These events do occur every few years. This is especially important for members close to retirement. Imagine that you are about to retire and going to buy a life annuity for your retirement income. Should one of these downturns occur on your retirement date, your fund value could deteriorate by more than 15 to 20% if you're invested in an average balance fund. A significant market downturn before retirement is almost certain to lead to a permanent loss of income in retirement. This is where smooth bonus portfolios add a lot of value. ensuring that members do not experience a negative return just before retirement.
That's a really wide range of scenarios that we've discussed, and it's comforting to see that in all of them, the smooth bonus products have delivered on the promise. This demonstrates that the cost is justified for investors who cannot afford to suffer the market ups and downs that we're seeing all too often these days. Thank you, Danie, for an illuminating session as always.